Hello, and welcome to the latest Expert Series webinar. Today's webinar is Sector Investing, Essential Building Blocks for Portfolio Construction. This is a complimentary ETF.com webinar, courtesy of Fidelity Investments and MSCI. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Matt Goulet. Matt is a Vice President of Business Strategy at Fidelity Select Co., a subsidiary of Fidelity. Matt focuses on the distribution strategy for Select Co. products across Fidelity's various distribution channels. It includes retail, intermediary, and institutional. Burt Malkiel, meanwhile, is a managing director and head of index applied research for MSCI. Burt is responsible for research to support new risk premia and economic exposure indexes, as well as plain vanilla cap-weighted indexes. He also serves as an ambassador to asset owners and managers on the role of indexes in asset allocation and portfolio construction. Before we get started, I'd like everyone to know that you can ask questions at any time during the webinar in the window at the lower right of your screens. We will have a Q&A at the end of the presentation, and I very much welcome audience questions as they are often unexpected and quite illuminating. The formal presentation itself will also be in the Q&A format, and it'll feature me asking Matt and Brett questions along the way. I've insisted on the basic questions that I have, or at least the framework of my questions, that be shown in individual slides to keep you all focused on the subjects and to help you all formulate your own questions and follow-ups that we'll field, as I said, at the end of the formal presentation. I'm quite excited to be moderating today's webinar. Fidelity's arrival in the world of ETFs began, for the record, early in the autumn of 2003. That's more than a decade ago. It was the launch of the Fidelity NASDAQ Composite Tracking Stock ETF. It trades under the symbol 1Q. It has $350 million in assets, but that was it from Fidelity in the world of ETFs for about a decade. However, a couple of years ago, this Boston-based giant in the world of mutual funds started stirring, filing regulatory paperwork describing ambitious plans for permission to issue all kinds of ETFs in both passive and active wrappers. More to the point, to today's presentation, the company launched Fidelity Select Co. This is the very subsidiary where Matt works in Denver. It is a unit focused on sector-focused investing. That's long been an expertise of Fidelity's. Fidelity Select Co. is product agnostic and wrapper agnostic, which is to say that what Matt's company does and what it focuses on includes mutual funds and ETFs and active and passive strategies. And the unifying theme, of course, is sectors. And that brings us to today's webinar. We'll be talking about the 10 sector funds Fidelity brought to market in October 2013, canvassing all the sectors of the U.S. equity markets. For the record, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, telecommunication services, and finally, utilities. They are built around MSCI indexes, hence Burt Malkiel's presence on today's panel. Together, these 10 funds now have around 550 in assets under management, which along with the $350 million in 1Q that I mentioned earlier, the first Fidelity ETF more than a decade ago, brings Fidelity's total ETF assets under management to just over $890 million, according to the numbers we crunch every day here at ETF.com. It's not bad for a relative newcomer to the ETF space. So we do have a lot to talk about in the 60 minutes today, so let's get right into it with some questions. And either of you could field this, but just to start this discussion off, it's pretty clear that interest in sector investing has grown, and significantly so over the years. And again, either of you could take a crack at this one. I presume maybe Matt, you should go first, considering you're sponsoring these funds. But why do you think this interest in sector investing is prominent and growing?
Yeah, thanks, Ollie, and thanks to everyone who dialed in for today's webcast. First, let me start off with a bit of background on sector investing, a bit of a history story, because I think it's an interesting one. If you look back to 1979 and 1980, we had skyrocketing oil prices, high inflation, and energy stocks had posted back-to-back years of annual returns over 30%. At Fidelity, we had a large end retail population who were continuously calling us, calling 1-800-FIDELITY, and saying, look, you manage my diversified mutual funds, you have a great research team, which 15 or so stocks should I buy to play this energy theme? So in 1981, we launched 4 sector mutual funds. It was metals and minerals, energy, healthcare, and tech. And as the 80s went on, interest in the technology sector, as we all know, skyrocketed. We continued to launch mutual funds to meet client needs until we had 44 actively managed mutual funds on the market. Now, fast forward to the late 90s, we were joined by ETF competitors who truly helped grow the sector market. Select sector spiders were launched in 98. iShares launched in 2000, and Vanguard launched a series of sector ETFs in 2004. But in 2004, the sector market was still relatively small. It was only about $200 billion in assets under management, with only 12% of that sitting in ETFs. And as you can see, it was a relatively small market and represented less than 5% of total equity mutual fund and ETF AUM. The point is that if you look back to 2004 or even the 90s and 80s, clients were still taking the Morningstar 9 style box approach for their equity allocation. I think the key moment for the sector industry, both mutual funds and ETFs, was probably 2008 and 2009. It was the single biggest year-over-year jump in the percentage of assets in sector mutual funds and ETFs relative to style box funds. And I think it makes sense. If you're an advisor creating a U.S. equity allocation in your portfolios, the lowest 10-year correlation you're going to find in the 9 style box framework is 0.85 between large cap value and mid cap growth. And you think about that, it's really remarkable. The fundamental building blocks of your diversified equity allocation move in the same direction 85% of the time. Compare that to sectors where you can actually find extremely low correlations going down into the 30% range when you look at financials relative to utilities. I think that's really what drove the growth of the sector mutual fund and ETF market is advisors, many of which who are probably on this call, realized they needed to change their portfolio construction methodology as clients continued to demand tactical solutions that mitigate downside risk coming out of 2008. And just to wrap it up, I mean, slide 3 really puts this as a good summary. Aside from company-specific factors such as earnings and free cash flow and the things that our PMs and analysts are tracking every day, the sector or industry in which a company operates is the single biggest driver of risk and return. In fact, and you can see it here at 22%, it's bigger than size and style combined. Just on top of that, one last note, they're intuitive. They make sense. If I ask my father, who's not in financial services, what style box ExxonMobil and Apple fall into, probably has no idea. But he knows that ExxonMobil is an energy stock and that Apple is a technology stock. Our research in this area, and you can kind of see it on this page in the disclosure there, is largely focused on U.S. equity markets. But I know Brett and the MSCI folks have done work on global markets to see if this concept holds true. So maybe you'll turn it over to Brett or back to Ollie.
Brett, you want to jump in right there?
Absolutely. Thank you. Both. If we look at the next slide, it really is the same question. Why sector investing? What is it? Why should we pay attention to it? And what we show in this little picture is the relative importance, the contribution of sector. Essentially, it says industry there, but it really means sector, as well as styles like value growth and country. So, are you in Japan versus Germany versus the U.S.? And how important are those things in explaining returns at various times since 1997? And you see that it bounces around. That's clearly going to be one thing to conclude. But there are certainly times when industry is extremely important, like between 2003 and 2009. And what this doesn't show is that over very long periods of time, the influence of country has come down. This obviously from an international perspective. We're not just talking the U.S. here. It used to be that investors would say, well, if in the international sphere, if you can pick the right countries, you've got it made, and it's just no longer true. If you had this going back to the 70s, country would dominate the discussion. Now sectors are much more important. Industry is the way it's classified here, but it's the same thing. Sectors are much more important in driving portfolio risk and return. And as a result, taking advantage of some of those low correlations that you just heard about from Matt is very important. If we switch to to the next slide, the question then becomes, well, what do we mean by sector or industry or what have you? And I think this might help out. This might give you a little bit of background. There's an actual formal methodology that's used called GICS, and it's actually a joint research effort by S&P and MSCI. And the idea is to put the experts together, and we do it actually once a year. We have a new round that takes longer than several months. It takes many months, but we start the cycle again every year to examine what are the right categories into which big categories into which to put things, and then what companies should go in those categories. So what it currently looks like is that there are 10 sectors, and you already heard what they are from Matt. 20 and their products based on those, indexes as well as products based on those. 24 industry groups that go into the 10 sectors, 67 industries and 156 sub-industries. It gets pretty complicated, as you can imagine. But the goal here is to try and figure out, start at the level of an individual company. Where should it go? What is the thing that best represents it when it comes to a sector or an industry or any of the other categories? And there's a constant process of re-examining that every year and significant research that gets done, because we want to make sure it's very consistent, as well as the other things that you see here: universal, accurate, comprehensive, and yes, evolving. Just to give you an example that might help you think about this is, what was Google 10 years ago? And what is Google today? And the kinds of things that we end up taking into account are things like, where does its revenue come from? In Google's case, it's obviously advertising. So does that make it a technology company or a media company? And I'm not arguing. I'm not going to get down in the weeds here and classify all companies for you in this. But these are the kinds of things that come up all the time, and we do careful research on it and to try and make this very consistent and very reflective of what you see out there. So that's the basic idea. It's sort of why sectors, and then why is it important to understand, why is it important to take a very research-driven and comprehensive approach to it, because then you're sort of getting what you pay for, or you're getting what the label says. Thanks. I guess there's
Thank you, Brett, and thank you, Matt. Yeah, the obvious question here, how do you think about these sector funds? How do they fit into a portfolio? I mean, are we talking? I mean, I'm tempted personally to think of these as strictly tactical tools, but I expect that's not what you're going to say. You might say, okay, that's fine, Ollie, but there's a lot more to it. So give me a sense, Matt, of how I should be thinking about this in the broadest possible terms.
I tend to agree with you, actually, on the tactical piece. I mean, at a high level, we conducted a survey of advisors when we were really reinvigorating our sector business last year in 2013, and we asked them, what percent average allocation are you allocating to sectors for your client portfolios? And I was surprised at the answer. It was relatively high at 12%. So 12% of advisor assets are currently being invested in sectors in some way, shape, or form. I suspect we have two groups of advisors here. Some who are building equity allocation entirely out of sectors, and this kind of goes into the F-Squareds of the world, Inialta, Stadion, many of these firms that have built businesses around sector allocation. But the overwhelming majority, when you look at the number of advisors, are probably in a latter group that's using them as tactical satellite positions, call it 5% of a client's portfolio or less. That being said, I think we've begun to see advisors incorporating sectors as a bigger part of the portfolio over time. And I mentioned before. Are
you talking about like tactical overweights and stuff like that, or is it more of a sort of a systematic ongoing thing when you talk about this 5% number or what have you?
Yeah, I mean the majority of portfolios we look at have a 10 to 15%. They call it an alternative sleeve. They call it a tactical sleeve. And if they work in a wirehouse, maybe they're expressing the home office CIO view of a Merrill Lynch or UBS, and maybe they're incorporating their own views, and it's a relatively small portion of the portfolio. I don't think we've seen widespread adoption of sectors replacing the style box for the framework, but I think it's growing.
Could it end up there, do you think, where the style box gets supplanted? Is that, or is it, I mean, you'd probably like to see it, maybe. Well, maybe not. What do you think about that?
No, I think it's certainly compelling for all the reasons we outlined up front and we'll address on this call. I think there's a case to be made for equity allocations changing in the United States today towards something that's different. I mean, this goes beyond sectors if you think about it. If you look at flows and you compare style block funds, not just to sectors, but to anything that has, a tactical, unconstrained, alternative tilt, those are the types of instruments that advisors are demanding today. Sectors fall into that. I think they're a big part of it, and I think they're easier to understand in most circumstances for the end investor, so they probably make a lot of sense. But this is a whole shift we're seeing in portfolio construction today since 2008, away from broad-based, diversified kind of growth and value funds and into other alternatives.
So there is change afoot, but it's not exactly clear where it's all leading to. Is that kind of what you're getting at here?
Yeah, I think it depends on time horizon too. I mean, you see people who are tactical and they're looking at 12 months out. You see people who are looking at 6 months to 5 years, and then kind of secular sector trends from 5 years to 30 years. And for those who are in that intermediate term, I think there's a lot we can do to educate them about the business cycle and economic cycle and which sectors tend to outperform or underperform the broad market when those market environments exist.
Is that it? The answer? Is that, or you got more to say? I was going to turn the same question to Brett to see if, from an indexing firm's perspective, there's another outlook there in terms of what sector investing, how it fits into a broader portfolio.
It'd be good to get that opinion.
Yeah, I mean, this is good stuff, and I think from our point of view, we want to look at and ask both questions. What about tactical? What about more strategic? And I think there's some applications for both. What you're seeing in the picture here are 5 of the 10 sector indexes, and that's something that an advisor can do is take a subset of the sectors, and in essence create a barbell. So you can see an example here where you have consumer staples, and then you have sort of defensive and pro-cyclical. You kind of divide it up into defensive and pro-cyclical, and you could either time that and take signals from the economy or from investment strategists and try and time your way in and out of it, or you could say, well, let's just take the barbell and invest in both. And that's a little bit like saying we're going to have both a value and a growth strategy, but you're actually more focused because these things are not just value and growth, they're actually defensive and pro-cyclical, so they're going to perform better at different times, but you're also not going to be invested in the stocks that are more, in the sectors that are more mushy. That's a technical term, by the way. And that's one way to do it. You can have that as a strategic decision, or, as I say, you can time it. And what it takes advantage of is the low correlations among sectors. Particularly, as I say, between the cyclical and defensive. So you see some of the low correlations, you say, we can take advantage of that. It ain't 0.85, as Matt was saying. It's considerably lower, and that gives us an opportunity to create even a strategic portfolio. The other thing that we want to point out is that I was talking just a minute ago about how we re-look at sectors every year. Well, that's true, but we don't make wholesale changes. What we're making is incremental changes to reflect the evolution of markets and the economy and the companies in them. So the turnover is pretty low because we're not forcing you to buy and sell different companies moving from sector to sector very often. So that becomes an advantage too because you're not spending a lot of money on turnover. So that I think that gives you a sense that we're a bit agnostic about tactical versus strategic, but it kind of depends on your motivation. If you have one or the other, you can implement those views. So let's take a look in this particular picture at some ways in which you could implement various views. What we've done in each case here is taken MSCI USA IMI. That's pretty much a mouthful of letters, but what that boils down to is a U.S. index that fits into the overall global index framework of MSCI. And the IMI includes small cap. Okay. So in each case, we've got about 50% allocation to small cap, to all cap in the USA space, large, mid, small. And then the other 50% is our IMI sector indexes at 5% each. So we're being agnostic about which sectors. In the second case, we're looking at same USAIMI, but with only defensive sectors, staples, healthcare, utilities. And in the third case, same thing, but then it's cyclical sectors. So the numbers you see over on the right are the results. The USAIMI index all by itself is the first column of numbers with a return risk ratio, or Sharpe ratio rather, of 0.24. And what you see is you get some advantages by taking a sector view, or taking various views on sectors, because the Sharpe ratios actually increase in each case. Now, the period we're using is 99 to 2014, but we've done this for longer periods of time, and the general results hold. We're not cherry picking times here. So the point here is, by allocating to taking advantage of the low correlations among various sector indices, you can get some diversification benefits and improve your Sharpe ratios. That's really where the rubber meets the road.
Okay. I have one question. We posted a question that I'm going to ask, but I have for you, Brett. I'm hearing you speak about how to conceptualize this. I'm reminded of a conversation I had with, of all people, Burt Malkiel a while ago. I asked him about sector funds, a pure indexer, right? The author of Random Walk Down Wall Street. You would imagine he would be totally poo-poo it, but he came up with an interesting idea, and I'm asking you, and I'm asking Matt. Is this really viable, or is Professor Malkiel just preaching the gospel of the ivory tower, disconnected from reality? He said that, imagine if you were at Enron and you engaged in some sector-based investing, where you held on to your little tech or energy piece via your Enron stock, which we now know vaporized completely, but the rest of it in your retirement portfolio was these 9 sectors. What a great way to use sector funds for people who have this diversification issue in connection with their various and sundry retirement programs with their employer. I thought that was interesting, but I had a hard time imagining that a lot of people are doing that in the real world. Is that a viable thing that advisors should think about, Matt? Do you hear about it?
Yeah, we do. I mean, you can call it, offsetting that risk, or just diversifying human capital in a sense. Whether it couldn't just be a single stock. It could be a pension plan, or just a general industry you work in, right? We all work in financial services. Maybe we all should be investing in equities X financial services and maintain that our career and our paycheck is our exposure to that. I mean, different people have different views on it, but we certainly see clients asking about that, and it's part of our job, I think, to deliver tools that allow them to look at their portfolio with a sector lens on it. And, not every advisor has access to those tools today, but I think it's something we aspire to, is show clients their overall portfolio sector weights, inclusive of stock positions and maybe even the human capital element. But I think it's absolutely valid, and definitely not one of those ivory tower concepts, as you put it, that we should disregard. It definitely has a real-life application.
Yeah, it sounds very interesting to me. Thank you. So moving on, there's certainly a sentiment that investors kind of think of sectors as risky and maybe steer clear of them for that reason. Whether they're right or wrong, what's your view about that? I mean, do you agree with that sentiment, or is that based on maybe incomplete information?
No, I mean, just to chime in here, when I hear this argument, I couldn't disagree more. I think it depends on the perspective, though. I mean, how do you define risk? So 2 points on the risk spectrum here. One, from portfolio construction point of view, like I said before, using building blocks that exhibit 0.85 correlations is incredibly risky in some sense. I'm a big hockey fan, and unless you're Happy Gilmore, you wouldn't use a hockey stick on the golf course. It's not precise enough, and I think the same applies to equity investing. Why not use the most precise tool that's available to achieve your intended outcome? I think the flip side of this, and we don't talk near enough about this in kind of the ETF and mutual fund world, is single stock ownership. And you touched on this before with your Burt Malkiel comment. If you look at assets on Fidelity's platform, we have close to 20, 30, 40% of client assets that are invested in single stock positions. And it's just incredible to me. The top performing sector year to date is utilities. I think it's up 12 or 13%. And we have clients asking us how to express views on the utilities industry, just like we did 30 years ago. And they may be better off using an ETF like the utilities ETF that we offer, rather than trying to pick between, Consolidated Edison or Duke Energy or something like that. So, our sector's risky. I think we definitively think they are not, but it depends on how you're using them.
Well, look,
is that Brett chiming in? Because I was going to ask you, you're focused on risk premia and how to kind of think of risk and extract factors and what have you. And how would you answer this question? Is there some truth to it? Is there any parsing to be done that could be advantageous to advisors and investors?
Well, look, let's back up a step here because and say, there's risk associated with any equity investment. There's an overall equity risk premium. There are risk premiums associated with different types of equity investments. So the answer is all equity investments are risky, just as pretty much anything but inflation-linked bonds. Well, even they are. So sorry to say. So let's just start from that. I know that's a no-brainer, but I just don't want us to forget that and start to say, oh yeah, don't worry about the risk here. However, the question then becomes, what type of risk are you taking? So there's the overall question of, how volatile are these things, and sectors tend to be more volatile than broader indexes. Absolutely right. However, what we've just been talking about is, are there ways that you can play this? And if you look on in this particular these particular bullets, if you look at defensive sectors, and they have lower beta compared to a cap-weighted index, and lower volatility compared to a cap-weighted index, they just don't move around as much, right? So they're not going to load on the risk of the parent index as much. However, look at information technology, and it's got high and as well as consumer discretionary in industrials, they're going to have higher beta. Okay, so the point is, one could take advantage of those things rather than just treating them as is this scary or not scary. So if you have a portfolio where you want to tone down the risk, you can emphasize defensive sectors. If you have a portfolio that you want to take advantage of of opportunities for higher gains, you can take advantage of, you can then put it into more infotech, consumer discretionary industrials. And so this is a little bit different play than just simply saying I want to time the market or I want to have a diversified portfolio. You can then say I want to adjust my risk level, and part of the way I'm going to adjust my risk level is using sectors. You're obviously going to use fixed income. You're going to use other things to do some of those adjustments. But this is another tool in the toolbox for doing that. So that's kind of a non completely obvious perspective on it.
Okay. I think we've been doing the 30,000-foot perspective here. Let's segue to the real world of competitive challenges that Fidelity has, bringing these funds to market. As Matt, you were saying, after some of the more prominent competitors, notably the family of sector funds from State Street Global Advisors. A lot of it comes down to the indexes. These are distinct indexes. I think, Brett, maybe you can take a crack at this question. What are the advantages of the index series on which these Fidelity funds are based, the MSCI USA Sectors IMI, over some of the other U.S. sector indexes that are underlying these competing products? And Matt, I'll ask you the same question here as well from your perspective. But Brett, take it away.
Oh, sure. Thanks a bunch. Here's an example. It's interesting. It's an interesting example in a way because, as I mentioned, S&P and MSCI jointly produce the GICS classification system on which these indexes depend. But there are several steps between a classification system and an actual product that Matt will get to in a minute. And one of those steps is, what's the actual index that you use? So in the case of MSCI, what we do is we take the entire U.S. equity market, and we don't leave out small caps. That's essentially the difference between what S&P is delivering and what we're delivering in terms of sector indexes. There's some other variations too, but this is the big one. And what we strongly believe is that if you have a methodology that enables you to create an index that is investable, so in the small cap space, some people might be saying, well, there might be some stocks that are hard to get. One thing that we do with our methodology is that we screen very carefully in that methodology on investability. We have a number of different investability and liquidity measures. They come into play very strongly in the small cap space, as you might imagine, more so than in large and mid, though not completely inapplicable in the large and mid space. But the result is that you get an index that's both covering more of the market and therefore more of the opportunity set that's in that market and is investable at the same time. So that so you see some of the differences here on the page. You get 99% coverage of the market. The 1%, of course, is that's left out is the uninvestable stocks that investors can't get hold of anyway. And instead of the 80%, and then you can see see what's going on in the bottom table. What difference does that make? If you just look at USA, which doesn't include the small cap, you can see some of the performance differences. So a risk-adjusted return increase when you start including the small cap over from 1998 to 2014. And again, you can go back even further and you get the same kinds of results. So that's a significant difference in at least at the index level. And I know that Matt is going to talk more about product at this point.
Yeah, I was going to say, at the risk of having you disparage your clients and encouraging you to start a war, can you put that into tangible context, what Brett's talking about here in terms of the products and the competitors that you face?
I can sure try. I mean, I think you could say, where does it matter? You could argue that the inclusion of small cap names doesn't matter for sectors like telecom, where they only represent 4% of the sector's market cap anyways. But in the case of sectors like industrials, materials, financials, small caps make up more than 20% of those sectors, and it's a huge driver of risk and return. And it flows down through, and Brett was touching on this, the sub-industry level. We hear clients all the time looking at financial sector ETFs, and in the financial sector market, REITs make up a large component of the small cap space, right? So if you're using XLF, the select sector spiders out there, that's about 14%. Real estate's about 14% of that portfolio. But generally, as you drift down into market cap and more into the MSCI, USA, IMI type products, you're going to increase your real estate exposure probably north of 20% in those products. And I think, again, it just goes back to the advisor. What are you trying to accomplish? In this case, I think you're going to get higher real estate exposure with an all-cap index, but maybe that's something you do or do not want. So we really put it back to the advisors, and kind of feeds into what we're really trying to do is educating folks about index construction, and we certainly rely on our partnership with MSCI to do that.
And I can imagine a scenario, people are talking these days that maybe the small cap premium is a little bit tapped out right now since the market bottom of March 09. Is there a case to be made that maybe the index that steers clear of those might be a good call and some sort of really finely tuned tactical approach to the sector-based investment universe?
Yeah. Let me jump in and say, as a former investment strategist at TI-CREF, one of the things I learned very quickly early in my career was be very, very careful when somebody says, this is all tapped out, we should run away from it. Because what that suggests to me is it's time to invest.
Right. Matt, you were starting to study something yourself. Do you want to jump in?
Yeah, it's just breaking down that when we talk about small caps, that we're really talking about the industries that make those up, right? Like I said before with the real estate piece of it, that you can do the returns-based style analysis either way. You can use growth and value factors or market cap factors or sector and industry factors, and it's telling different stories, right? So I would want to look at the sectors that underperform recently and just say, what's going on at the sub-industry level? What's going on with biotech relative to pharma, relative to medical equipment within the healthcare sector? Because I think that's what's going to explain a lot of those differences in risk and return.
Right. Now, one of the things that comes to mind in terms of MSCI, Brett, is that the Vanguard suite of sector-based equity investments also has MSCI indexes. They're awfully similar, but not identical. Am I correct, or am I going off the reservation here with that characterization?
No. Yeah, they're similar, but not identical. Absolutely right. So you're interested in what's the distinction, right?
Yeah, what is the difference, in fact? I mean, and I'm guessing that you or Matt might say it does matter. So, yeah, what is the distinction?
Yeah, let's let Matt talk about the why it matters, because I think that's going to be he'll be very effective at that. Well, look, the key distinction here is that or where does this all come from, I guess I should say. What happens is that Vanguard approached us a number of years ago and asked for us to create some indexes that were that matched the way that they matched their investment style. And so the distinctions are, for example, there's a distinction between value and growth, and that's something that's familiar to everybody. There's also the size cutoffs are distinct in the sense of large cap goes down to about 450 stocks, and then you get down you go down to mid cap and then small cap. So the size cutoffs are going to be different in the case of the Vanguard indexes. And the question is, what difference does it make? Well, there's a lot of correlation among them, but there are some key differences as far as an investor is concerned. I think what's going on is that you see that again, this fits kind of Vanguard's way of thinking about the world. Why MSCI has an alternative way of doing it, which is in fact MSCI's mainstream way of doing it, is that we developed a methodology a number of years ago, which we nicknamed Jimmy, but let's talk about that in English instead of geek talk. And what we do is we start with a global equity opportunity set, which means what are all of the investable stocks in the world? And can we pull all those together in one comprehensive framework where the methodology is very consistent? Then how do we cut it up by size, by country, by whatever, and then by sector, so that all of the pieces fit together, not just at the USA level, but all the pieces fit together and are consistent in the U.S., outside of the U.S., they roll up to regional indexes, and then finally roll up to a global index like ACWI IMI. And that's one of the key kind of architectural distinctions that we make. Matt, and Ollie, let me turn it back to you.
Yeah, I could chime in there. I think.
Yeah, please do.
On the head. It's if you look at the average kind of institutional portfolio and what they're benchmarked to, MSCI, ACWI, IMI, an all-cap global benchmark. The MSCI USA series that the Fidelity sector ETFs track roll up to that. So you're kind of reducing overlap if you're mixing and matching index providers and ETF providers as you're creating a global portfolio. To get really into the weeds, I think there's a subtle difference between the indexes that Vanguard tracks and the indexes that we track, and it's in the USA versus US. And we talked about this before the call, but I think it's interesting that USA is going to take a global investor's perspective, and the U.S. government actually caps foreign investment in certain pieces of our infrastructure and our economy that are critical. So things like airways, airlines, highways, toll systems, things like that. So those industries will likely have a smaller weight in the USA index that Fidelity tracks relative to Vanguard. Not saying it's a better thing, worse thing, but I think it's something to be aware of, that you're going to see subtle industry differences between the two products. Probably, like we said before, not a huge driver of risk and return, but it is helpful to know that they are different indexes and they do behave differently in certain environments.
Okay, thank you. Yeah, please.
Oh, I was just going to add one sentence. Sorry, Ollie. The way to summarize some of this is that in the MSCI, ACWI, everything rolls up and down, and everything can be cut up and put back together again. You end up with no gaps and overlaps. You're not buying the same stock in two different places, and you're not leaving out stocks. Whatever you're doing is an intentional and not an unintentional bet. And I think that's the kind of way to see this.
Okay, great. Thank you. Now, again, where the rubber meets the road, you're latecomers of the game, Matt. But we're very big here at ETF.com that the next phase of the ETF industry's development is really about distribution, which may well obviate any perceived disadvantage that Fidelity may have for having waited a decade between the launch of that NASDAQ fund and all these sector funds and more to come. So you have this massive distribution capability. You have an ability to reach out to advisors and clients as you launch into this Fidelity SelectCo project. Give us some color as to what is it that you're doing to help educate clients. What is it that you're saying? What are some of the conversations like?
Sure. I mean, there's two parts of it. The first part touches on what you said earlier about being product agnostic. At Fidelity SelectCo, whether it's mutual funds or ETFs that advisors are using, we don't have a strong view one way or the other, but we're using we're using a lot of the asset allocation research team at Fidelity to put some thought leadership around there. And I mentioned this before, is if you're an intermediate term investor and you're looking in the 1 to 5 years, fluctuations in the business cycle, they're going to be subject to distinct changes in kind of rate of growth with economic activity, increasing and decreasing rate in corporate profits, credit, inventories, things like that. So we have a team that's tracking those economic factors and telling advisors where we think we are in the business cycle and which sectors will be overweight and underweight if that's your time horizon and your level of sophistication. So currently, we believe we're in a mid-cycle that favors technology and industrials, and I think that's just educating clients about how to put these pieces together. It's tough for an advisor to look at the sector ETF and mutual fund landscape and try to pick the sectors, so we're trying to help them do that. The second piece, like you mentioned before, is the ETF education piece, and frankly, I think ETF.com's probably done a better job than anyone on doing this. These ETFs, the Fidelity sector ETFs, are sub-advised by iShares, and from my perspective, they're probably best in the industry at balancing things like tracking error, liquidity, tax efficiency. So we're really just talking to our intermediary and retail clients, educating them about what's important when evaluating ETFs, and having some of those same conversations that we've had in the industry for the last decade or so. It's just ETFs 101, how they fit in a portfolio and how you can use them.
Brett, is there sort of an analogy in the indexing world? I know you're sort of once removed, and some people read the name of a fund and they don't even know what the MSCI thing necessarily means. I think that's a diminishing problem. But is there a message that from an indexer's point of view you would communicate to investors, given the opportunity to shed light and to enlighten people as to what they should be thinking about as they contemplate which product is appropriate?
Well, look, it's a similar message. It's what you want, what you're looking for in a sector product, in any and this actually goes for almost anything that any kind of fund or ETF or whatever you're examining, is you want to know what's in it. You want to know that what you're buying is going to give you what your goals are, and it's going to help you meet your goals. So you're looking for something that is built on an index that's clear, understandable, transparent, and doesn't mix apples and oranges. And I think that's really key in the sector area. Obviously, with one of the things we've been saying today is that MSCI takes that same attitude toward building its sector indexes, and so to me that's part of the advantage.
Yeah, and just one more note there. I think we continue to look at ways to develop tools for our advisor clients. On our retail site, we currently have a sector portfolio builder tool. It's one of the only tools out there that you can actually mix and match mutual funds and ETFs to create a sector portfolio. And I think it's like Brett said, the thought leadership, the education we need to do that's going to drive the sector business going forward. And I think we're in the early days of it too. Something you said up front was, is Fidelity late to the game? I think, we've recognized that the likes of iShares and Vanguard and Spiders are probably good at what they do. It's passive index management. And in the sector space, we see clients being active, but using passive building blocks to create active allocations within their portfolio. So I think, going forward, these products in the ETF world are just going to become more complex, and it's going to require more education.
Right. Well, I wanted to encourage the audience. I'm going to ask a couple of extra questions here that are a bit more impromptu, and I want to encourage the audience to ask any questions that you might have. Again, as I said at the beginning, you can enter those questions at the lower right of your screens. We have quite a number of them that have come in already, so thank you, but keep them coming. I wanted to bring up the issue, Matt, of expense ratios. Certainly, as we watched from afar at ETF.com, we were wondering, are they going to do the right thing in terms of gesturing, to a public that is coming to expect rock bottom expense ratios? Well, I would say you delivered the goods. You do have bragging rights on expense ratios. 12 basis points, right? That's $12 for every 10 grand that's on the table. Not too shabby. Can you shed some light on how that was arrived at, that decision? Because it was certainly, for what it's worth, I'll parse it and try to cut it apart in a minute, but it was impressive. Sure. What was the thinking?
Yeah, Ollie, like you said before, I think we look at total cost, and total cost is not just expense ratio. It's tracking error, it's capital gains payouts, it's liquidity, what price can you execute, and it's commissions. So on top of the low expense ratio, we're actually offering these products commission-free to many of our custody and clearing and brokerage clients. So you're seeing that demand on the secondary market right out of the gates, which is kind of nice from an ETF provider's point of view. But regarding the expense ratio, yeah, you're right. I think it's lowest, I know it's lowest in the sector marketplace. It's an area we expect to be competitive in, and we know for passive instruments, that's what clients are looking for. But I think as the industry evolves and you see more strategic beta exposure or even full-blown active ETFs, I think there's the argument to be made that you can charge a higher expense ratio for adding value to clients' portfolios. So I think we're happy with where we are in the market from a competitive point of view, and our clients certainly seem to be happy too as they continue to put money into these products.
Thank you. And at the risk of going into terribly obvious territory, I'm going there anyway. Expense ratios are not the whole story in terms of ownership costs of a fund. There's trading them properly. There's tracking, as you alluded to, and I want to get into the BlackRock partnership a bit more in a moment, but can you talk a little bit about the bid-ask spread, the sort of support that Fidelity will provide to advisors to trade smoothly, thoughtfully, without getting hurt in the traffic.
Sure.
And also, we can talk about tracking separately. It'll bring BlackRock into the discussion, I expect. So yeah, please shed some light on it and just paint the picture, the whole cost picture.
Yeah, I think we've actually learned from the lessons of other ETF providers over the years, where the big three have developed robust ETF capital markets functions that are helping educate advisors about how to achieve best execution, how to evaluate a bid-ask spread and work with liquidity providers. And then there have been other newer entrants to the market that haven't done that haven't worked with the AP and market-making community to ensure that the liquidity ecosystem is working effectively. That's something we learned, and that's something we determined from day one, is that if Fidelity is going to be an ETF business, we're going to have an emphasis on liquidity, on best execution, because we know that's going to be an explicit cost for advisors and their clients. And like I said before, it's just going to become more important going forward. On the tracking error front, same story there. We decided a long time ago that we wanted to be an ETF market. We wanted to be best in class in everything we do, and we felt like iShares was a phenomenal partner to help do that. You mentioned before their tracking error is razor thin. They've got a phenomenal index research group, and if you're launching passively managed indexed ETFs, they're probably the right sub-advisor to select. So like I said before, it just comes putting the whole package together when developing a product and designing it. Is you want the best in class for everyone. And quick shout out to MSCI too. I mean, the same goes for MSCI. I don't know what the stats are. Brett probably knows, but I think they have indexes that over 700 ETFs or something like that are tracking. So as far as I'm concerned, they're the gold standard when it comes to indexing. And we appreciate the partnership of all of these vendors, iShares, MSCI, and the market makers.
Have you done any analysis, Matt, as far as what the ownership costs are? This is an audience question here. If you're trying to stack up one versus the other, I mean, the sort of reflexive point of view would be like, oh, the spiders just beat the pants off of everything. They've been around so long, they're so liquid. But that's not the whole story, because the underlying are quite liquid, right? All the underlying stocks that are part of these funds are very accessible. I guess if you're a very large player, you can move large blocks or even creation units of ETF shares and pretty much get a killer deal, right? But what is it like for every man? I mean, is there still an opportunity to get creamed here, or how good is it, or how bad is it, I guess, relative to the other products out there?
Yeah, again, credit to ETF.com for educating people, and everyone on this line has probably heard it before, but ETFs are as liquid as the underlying. And for many of our clients, we're seeing large orders, $8, $10 million, $20 million and up, being executed within a penny or two of the bid-ask spread in many different circumstances. And these products have only been on the market for 6 months. So we absolutely have a few case studies, happy to distribute after this call if anyone wants to reach out to me, of advisors who have put large positions into these products and felt comfortable with the execution they received. So like you said, I just think these things are as liquid as the underlying. We continue to educate about that, and even the Michael Lewis Flash Boys book in the last couple months has put a renewed interest in this area of ETF liquidity. So we're doing our part to educate advisors.
Thank you. To your point about sector investing expanding and some shifts in the underlying investment market since the subprime mortgage crisis helped cause the collapse 5 years ago. Why have some global sector ETFs been closing? I mean, are there clear limits to this, or is there a flaw in marketing? I guess this is another way of saying, is Fidelity Selectco going to be going more deeply into the sector thing in a huge way? I know you maybe don't want to show your hand, but clearly, like, you know, in January when we did our Inside ETF conference, I think it was iShares that shut down a whole family of global sector funds, and it was kind of like scratch my head a little bit. I thought some of those concepts seemed good. Are there limits here somehow?
Yeah, I think from an ETF provider's point of view, there's a number of providers out there with either ex-US sector products or global sector products or even emerging market sector products. And some of them are interesting as tactical views, but as a suite of 10 sector products, we found that advisors just aren't allocating their portfolios that way. If you look at the 60% equity allocation just kind of on standard, and let's say they have 20% of that in international and 40% in US, they're really picking managers or ETFs for both of those markets. They're using things like EEM and VWO for emerging markets, and their U.S. portion, they're either using sectors or style blocks. And I think the average advisor looks at them differently. It also may be an issue of number of holdings, right? If you're creating an equity portfolio and you're already using 10 sectors for the U.S. equity sleeve, do you really want to add another 10 CUSIPs or tickers to your portfolio and incur those commissions and trading costs? I don't think it's flawed marketing on the side of the ETF provider's perspective, and I certainly don't want to show our hand, but I just think, you know, it's difficult to make the case for international sector products as kind of holistic portfolio solutions. They're really better as tactical views in the market, right? If you want to play the emerging market consumer, that might be a good product. And then, you know, the side part of this is that certain sectors are global in nature anyways, right? If you're launching a gold mining ETF or something like that, many of the gold miners are domiciled outside of the U.S. It's going to be a global product. And I'm sure the same could be said for energy and for certain natural resources exposures. So I guess my point is some sectors and industries are global in nature, and we'll continue to see those products drive flow and drive assets. But creating families of, you know, 40 or 50 ex-U.S. sectors may not be what advisors are asking for.
Got it. Now there is a number of questions. I'm going to try to combine them into one hopefully efficiently framed question. We had one. It's more of an observation, but it's a good basis for a question. One of our audience members observed that they had used Fidelity Advisor sector funds years ago, and the performance wasn't terribly good. The fund performance was quite volatile. So take that data point, consider it for a moment, and you talked about a tool on the Fidelity website, Matt, that could help people conceptualize how they would travel in this market, you know. And we have a audience member who asked, would you discuss entry points? How might you enter one sector and exit another, or buy a number of sectors and just hold them? So, you know, how do you approach this? And it's obviously a lot of moving targets here, but help us out here.
Yeah, sure. I mean, on the first question, like we said before, we didn't spend a lot of time talking about the kind of the sector funds that started it all, right? These 44 active sector mutual funds at Fidelity that have, I think it's close to $70 billion in assets today. And I actually looked at it the other day. I mean, the select sector SPDR products were launched in 1998, so we have this robust 15-year period. And in, I think it's 7 out of the 9 sectors, the active products net of fees actually outperform the passive instruments. And it's, you know, it's something we're working with some of the research shops and probably ETF.com and the Morningstars of the world to do some more research on. When you look at, you know, call it like a SPIVA report, Standard & Poor's Index versus Active, we're not typically seeing a lot of research firms do analysis of active versus passive within the sector space. And I think there's a compelling story for active management for some advisors, but for those who don't subscribe to active management, ETFs are certainly a good solution. On the second note, the sector portfolio builder tool, it's available on Fidelity.com. There's an investment product section. You can kind of click on the link and play around there. We're talking about making that available on our advisor website, advisor.fidelity.com. But aside from the tool, I think there's a number of different thought leadership papers that you can download and get I think they're called State of the Sectors, or our year-end sector piece. looking at positioning points, and I think the question is, when do you get in, when do you get out? No doubt it's difficult. I think that's why you've seen many sector allocation firms grow so significantly, is that people need help determining when to go in and when to go out. I don't have a great answer on kind of today, March or April 30th, where to go and how to do it. But I think if you're looking at the research and looking at what Fidelity and other sector research firms are publishing, you can probably get a good feel for where PMs and analysts think the best opportunities are.
In the mid-cycle, you called it,
yeah.
I presume, yeah. Now, there's a couple of questions centering on correlation between the different the sectors, the sector ETFs, the indexes. What kind of correlation is there to each? Maybe this is a question for you, Brett.
Well, we've already argued in general that that you see correlations that are much lower than the broad market correlations. This 0.85 number we keep kicking around. What I think you can do is say what you can pick off are sectors that have quite low correlations, including down to half of that. Let's say you pick off consumer staples and healthcare versus let's say consumer discretionary and industrials, and you'd be kind of in that range. So what I kind of think of is you take groupings like your defensives and your pro-cyclicals, and you kind of pick one from column A and one from column B, and you'll generally find very low correlations. Matt, you may have some more specific numbers.
I think I've got the same numbers as you. Like we said before, the sectors are not risky unless you're kind of bundling them into the ones that tend to move together. And like you said,
right,
consumer discretionary tends to move with financials and industrials and sometimes technology. And it's just as basic as kind of getting your hands on one of these periodic table of risk, periodic table of returns, and maybe a correlation grid. And I think, we're like I said before, MSCI has those tools. We have those tools. We have that thought leadership,
right.
And it can help you inform your investment thesis.
Please go ahead, Brett.
The easiest way is for your folks on the call is take advantage of the tools that are available at Fidelity. You can also come to MSCI and find our research paper. We have a terrific research paper on sectors, and that explains a lot of this stuff, including has the correlation matrix.
Great, thanks, gentlemen. We're just about up on time. Let me just ask you one quick question. There's clearly an appetite for Fidelity products here. Matt, there's a question that came in from the audience, really extolling the virtues of the Fidelity Select mutual funds. They said they're great, and can the world of advisors and investors expect Fidelity to come out with a similar group of ETFs? For example, 44 sector ETFs covering the U.S. market.
Yeah, I'm glad we have so many fans of the active mutual funds on the line. I didn't expect that, to be honest. I think we're constantly looking at ways to develop our product line. And the amazing stat that I leave with everyone is if you look at ETF market share relative to mutual funds in the United States today, it's highest in the sector market. Over 45% of assets in sector as an asset class are invested in ETFs, whereas on the whole, it's only 13%. If you're doing international equities, only 17% market share to ETFs. So the point is, the reason we launched these products is because we knew for sector investors who are likely tactical, they're more and more moving towards ETFs, and it's certainly a discussion we're having in the halls of Fidelity right now is how do we continue to deliver that vehicle to our clients. But, without showing our hand again, and because we haven't filed for anything, we can't say much more on that topic. But I think we certainly recognize the trend towards ETFs when it comes to sector investing.
Thanks a lot. We're out of time now. We did leave a few questions on the table, but I want all the audience to know that we'll do our best to hook you up with Matt or Brett if you have any follow-up questions, and there are some that are germane to both of your worlds, Matt and Brett. So that concludes our Expert Series webinar on sector investing, essential building blocks for portfolio construction. Matt and Brett, and I want to thank you for being my guests. And I want to thank the audience for attending and for the interesting questions. As I said a moment ago, we will broker contact between you and our guests today to make sure that these questions are answered. Again, this presentation will be available to all of you in 24 to 48 hours, and you'll receive instructions on how to obtain it in an email. On that note, on behalf of Matt and Brett, my guests from Fidelity and MSCI, as well as all my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.